Here we go. Welcome everyone to Life After Pre-Seed, preparing for your seed round. So my name is Adam. I run partnerships here at Metal, which is an AI-powered fundraising intelligence platform built for founders. We help you identify the right investors, map warm introduction paths, and manage your pipeline so you're raising with precision instead of guessing. We're backed by a bunch of amazing investors, including A16Z and YCombinator. Everything we build is designed around one goal, though, and that's to help founders raise smarter and faster. And we are one of the hosts of this event. We have an amazing co-host in Kristen Kraft of Fidelity Private Shares. Kristen, would you like to say a few words?
Sure. Thanks so much, Adam. I am so excited to be here for so many reasons. Thanks so highly of Adam and his team, but also of Haley and Renny, two of my favorite people. And I'm excited to let them share their incredible knowledge because building a company takes a lot of work. It takes a lot of knowledge. To borrow a phrase from Haley, it takes seeing around corners. And so that is really our goal for today. And I myself am a former founder and then longtime startup operator as well as angel investor. So I know how important and valuable it is to get perspectives like the ones that everyone will get to hear today. So thank you. And I'm super excited.
Right on. Thank you. Thank you, Kristen. Before I introduce the panel, just a quick reminder of like what we're going to talk about today. So through this conversation, we hope to uncover insights around some of the most important aspects of preparing for a seed round. As our panelists give their insights, I encourage the founders to think about two things. The signals that matter. So what are investors actually like reading between the lines with? At seed, at the bar, it shifts significantly. And our panelists are going to tell you exactly what they are looking for and when. Also, I want you guys to be thinking about milestones and positioning. So like seed ready means something different to like depending on who you're talking to and what you're building. So we're going to unpack what it really actually means in practice so that you can benchmark yourself more honestly. And in order to do so, we brought in some amazing VCs to give their perspectives. Haley Bryant is a partner at Hustle Fund, one of the most active pre-seed firms globally with 500 portfolio companies, 500 more than 500 portfolio companies, known for writing first checks and backing founders anywhere from who look like anybody. Before venture, she was an operator building Apple's small business program, then scaling content agency Animals from 2 million to 14 million in revenue as COO. That background shapes everything about how she evaluates founders today. Execution and first principles thinking over pedigree. She has reviewed more than 10,000 companies. Jeez, Haley, which gives her an unusually sharp eye for what seed ready actually looks like. Haley, I'm sure you have a lot more to say about Hustle Fund, so I'll turn it over to you real quick.
Thanks, Adam and Kristen, for hosting us. And Renny, so excited to jam with you today. Thanks for everyone who's tuning in. I'm Haley. Hustle Fund invests hilariously early. We're the first check 50% of the time. We care the most about founders who hustle, which we define as great execution meets high velocity. We don't specialize in any industries, but I'm spending a lot of time right now in critical industries. And over the last few years, I've spent a lot of time in vertical AI, as well as in and around healthcare and marketplaces. So excited to dive in today.
Right on. Thanks, Haley. And introducing Renny McPherson, who is the first managing partner at First In, the premier early stage fund for security technology, leading seed rounds in cybersecurity, data intelligence, dual use, and defense tech, currently out of Fund 3. He came to investing the hard way through the Marine Corps as an intelligence officer, national security policy researcher at RAND, then the co-founder of Red Owl Analytics, a security company acquired by Raytheon in 2017. He's a Harvard College and Harvard Business School graduate. His lens matters today because security tech is a sector where conventional seed signals simply don't apply all the time. And that contrast with Haley will make for a pretty sharp conversation, I'm pretty sure. So Renny, I'll turn it over to you real quick. Anything else you'd like to add?
Thanks a lot, Adam and team here, Kristen and Haley. Really appreciate being part of this and to be able to have an honest dialogue for founders about what VCs are really thinking when you're approaching your seed round. happy to do it. We are very much a specialist firm, and for being a specialist firm, we have specialized expertise and partners. My business partner, Arthur, was head of corp dev at a leading defense tech company called Anduril, and also, like me, a Marine Corps officer in a past life. And we believe that to be a specialist, you need that kind of lens. But really excited for the conversation today. Thank you.
Right on. Thank you so much, Renny. All right. Hey, let's kick this off with the first question. I always love this one, especially when I'm talking to operators. So you both came to investing after operating and building. Should founders be pitching operator turn investors differently than non-operator first investors?
I'm happy to jump in.
I'll go with Haley on this one.
Okay, yeah, happy to jump in. So I think maybe stepping back from operators versus non-operators, I think it's so important to just remember who you're pitching in general. Like VCs are humans first. So at the earliest stages, and I would include seed in that, we are underwriting people as much as markets and ideas. So creating a connection is super important. When I first started in VC, so many people asked me like, how's the transition going? And I didn't really understand what they were asking, like the transition from operator to investor. But I think what they were implying is that operators tend to look at opportunities very differently, maybe more bottoms up than investors coming from an investment banking background or private equity background that may be more top-down focused. So when I say bottom up, I want to know everything you know about your customer, how they buy, what their problems are, what's the first thing they turn on and last thing they turn off in their day, what's the sales cycle like, who else are they working with, what are their incentives? And that's like how I go into an opportunity. I eventually get to the market, of course, but it's much more about that customer connection, your right to win, that customer distribution advantages, how you're going to drive adoption. Whereas in talking with a lot of professional investors, I often hear like, we want to hear about the market size and CAGR and the value chain. And these are all really important things to figure out sooner than later. So you have to bring both. But I do think it's important to understand what perspective the investor is coming from. And it may not be, again, operator, non-operator. It may be also, were they a consultant before? Were they also a founder before? Are they more of a vibes investor, like focused on that connection? Or are they much more focused on like logic? And this is how we're going to make money. And I think it's so much easier now to figure out who you're talking to because of the tools that are available that let you like listen to podcasts at scale and review blog posts and understand how people at least say they think, to give you more grounding, which I think is one of the huge advantages that platforms like Metal can give you.
I appreciate the shout out there. Renny, what's your take?
Yeah, Haley put it really well, and I think there is more information out there than ever about the people that you are actually going to talk to and pitch. So make use of that. And Haley put it really well. You're pitching humans, right? It's not, was this person an operator or not? It's who is this human that we're talking to, and trying to make that sort of connection is essential rather than taking the deep breath and like talking for 20 straight minutes. Right? I mean, you're talking to a person. Hopefully, it's a conversation. I think perhaps having been operators, as Haley and I and many people on this from this side have been, there's a level of kind of understanding and empathy for what you're facing, but certainly it's the actual pitch to the person that, by the way, might be your partner through good times and bad for the next 3, 5, 7, 10 plus years. So keeping that in mind is critical too. But Haley put it great.
Just to like build on that before segueing to our next question. I mean, I think both of you touch on such an important point around like it's around the person. And I think there are certain attributes that probably most investors look for, like high IQ, high EQ, high adaptability. One quote that someone shared with me years ago that has really stuck with me was, an investor friend said, Kristen, I think like the process is the proof, i.e. the process that you run when seeking capital, like is the proof of who you are. Like, do you follow through and do what you say you're going to do? Are you gracious? Are you thankful for the time when you have time to meet with people? Like, those are the proof points that ultimately help an investor gauge and sort of, you know, really feel more conviction about the proof points of who you are and what you're building, how you like to build. So both of you made such great points along those lines. I couldn't resist jumping in with my favorite quotes. Sticking with this idea of that operator background, do you think that, you know, your own backgrounds as operators make you either like more or less patient with a founder, you know, as you're getting to know them and trying to, you know, decide whether to invest? And Renny, maybe like we'll start with you this time, if that's cool.
Yeah, happy to take that first. So the question is, am I more or less patient having been a founder before? And I think it cuts both ways, right? I mean, having experienced having to go pitch VCs years ago, but I can still remember many of those pitches that didn't go well, some that did go well. I think I would take it back to like empathy. Like I understand, and you know, I'm willing to get to know people. I think I would say one thing that changed from the earliest days I had doing this as an angel investor, scraping to get together what capital I had at the time to invest in people I really respected in the mid late 2010s. Um, something that has evolved over time is the further away I get from having been a founder myself, I think the more I've begun to appreciate we can support people along the edges, but they are the founders and they need to stand on their own. If you had talked to me in 2021, a year after I'd started this firm, I would probably be telling you a million ways that I and our advisors were going to help you and we're all going to do this together. And I think the further away I've gotten from that experience, the more I'm like, that didn't really work so well. We're not building the business with you. And again, we're a seed stage firm. We're not an accelerator, but that is one thing that has changed for me over time.
Interesting.
Yeah,
That's
Renny, that's super. Oh, sorry.
Go
Go
ahead.
ahead, Haley.
No, go ahead, Adam.
I was gonna say that's really interesting. It seems like you know, a lot of times founders are thinking that investors are gonna like, you know, make the world turn for them. But the reality is like it's probably better, right? If founders are owning their own business a lot more. They're in it every single day. So yeah, curious to hear how Haley sees that as well.
Yeah, Rennie, great point. And I have a feeling you're being very humble in terms of your ability to help founders, just given how deep you are in your space. Kristen talked earlier about seeing around corners. I would imagine that's one of the big ways that you help. It's like just knowing where to steer the car, even if you're not in the driver's seat. So that's huge. We love learning from the work you're doing at First In. Yeah, I mean, I think Kristen's point around the proof is in the process is so spot on. There are founders I've backed where I wasn't sure about the idea or the team, and they were so persistent in how they ran their process that I was like, I want to work with. I want to work with this team. Actually, one of the largest checks we wrote in our third fund was into a team I initially was on the fence about. And I ended up pitching, like, please take our money because I just fell in love with them through the process. So I do think it's a way to build rapport to show that you are able to run a really tight sales process, right? It's analogous to a sales process. Um, in terms of the question around patience, I agree with Rennie. It's about empathy. Like I don't know how tough your day is, but I can imagine when you say, oh, you know, I have 10 pitches today. That's really hard. Like I have 10 pitches with LPs too. I feel you. Where I'm less forgiving around mistakes is some of the easy things that you know, it's just kind of best practice at this point around how to run a process well, that it's so available. If you're not kind of taking notes on that, it's sort of a red flag. So maybe we can dig into that more.
Yeah, absolutely. Actually, that's exactly where I wanted to go with this. You mentioned many times like how a demonstrating like a really tight process around their fundraising efforts is a really positive signal. How like I guess how does this show up for you with founders?
Yeah, so Kristen mentioned the follow through as one thing, like doing what you said you do. So we're on a call, I have a question or I ask for a piece of information. When I get that follow up in my inbox in, a day, hours, or even minutes, it's impressive, right? I know you have a ton of things going on, so the fact that you're able to thread that needle is huge. Being able to build momentum in your raise, I think this is where a lot of seed raises fall apart, especially because maybe you had a great pre-seed round. You're getting offers for warm intros here and there and taking all these one-off meetings and thinking you're building relationships, but it's really hard to build momentum when you're just taking one meeting a week. You have to really tightly sequence a process so you can share updates consistently, often every week over the course of a seed raise. That's like, it's a sprint, right? It's a marathon, but it's a sprint. So these are some of the things that I look for, but yeah, curious to hear from Renny on what you've seen and what best practices you can share.
Great. Yeah. And I'm just seeing some of these questions in the Q&A. Happy to like weave these into to what we're discussing, Adam and Kristen, or wait till the end to address you all let us know. But yeah, I mean, I think maybe I'll use just a couple make a couple statements. Haley and I and people in our seats talk to, many hundreds, if not 1,000 founders per year. And at First In, I probably lead 2 to 3 investments per year. Used to be 3 to 4 to 5, but now I have a full-time GP partner, so he does half of it. That's a very small percentage. So a lot of what we're doing is we have to evaluate on a very quick basis. I heard the fact that Haley's talked to 10,000 founders. I haven't tracked every single interaction, but that's a big number. And I think in those initial meetings, it's like, is this person strategic and has vision and simultaneously is able to execute? Or are they kind of head in the clouds and they're never going to get there? Or are they very tactical but can't kind of sell the bigger vision? Those are the things that I'm most looking for. And I think another statement I'll make is I have to send, typically it's emails, right? If I've gone really deep on diligence, we'll obviously like do phone calls or, to talk to people about the why we didn't invest. But I send hundreds of emails every year saying, hi, this is Renny from First In. Thank you for your precious time. We are not going to pursue an investment, right? And I would say just for all the founders out there, the way that people handle that says a lot. And just a fact is often a pre-seed founder, instead of doing a full seed round, will end up doing a bridge. And then that founder is back pitching me 6, 12, 18 months later for a small seed or a big seed or even a small series A. And the founders who are like, Renny, thanks so much. Really enjoyed our time. Understand your process, understand your decision. Thank you. Great. But often a founder like will just not reply to that email and then will pitch me 6 months later being like, hey, now we're doing our seed. Like, you need to invest. And you're just like, whoa, like I thought we were humans here. You kind of ghosted me after we had this dialogue at the end, or, you were really adversarial in the why did you pass exactly kind of statements. And it's like, I, there are, look at Metal. There are thousands of venture firms out there. We're just one. We only invest in 3 out of however many companies. And just to draw the corollary so that you understand what Haley and I do with a lot of our time, building First In, having been an angel and an operator who had a modest outcome, those early years, a lot of my time was dedicated to pitching LPs on why they should invest in First In funds. And talk about painful and talk about people not getting back to you. Like, welcome to the world of pitching, LP family offices and registered investment advisors and et cetera, fund of funds, et cetera. So we live it every day too, and are judged on these same ways of like, how do you deal with the constant rejection, right? And frankly, what Haley, I won't speak for Haley, what I'm also evaluating is like, if I say, hey, like this is not for us for now, but like please let's talk in 6 to 12 months, I really mean that. And don't if you just ignore that or have a really adversarial sort of like I didn't need you anyway. It's like, whoa, okay, like, sorry, but like now I'm not gonna think of you when a friend of mine who's really interested in your subsector wants to invest in your company. So just it's a long game, and it's amazing to me how many people don't view it with that longer term lens.
That's such an important point and very relevant actually to like a couple of the questions that came in via Q&A. One individual, thank you for asking, was like, hey, what is this process like that I should know about? So I do want to like just take a sec to talk about that. And then the related question was like, what's the line between good persistence and like maybe too much or adversarial or like annoying persistence? So I just want to touch on that for a quick second. Given my lens of working with like hundreds, if not thousands of founders in any given year, watching their fundraising process, just to sort of calibrate, like, first of all, this is a little bit of a pipeline or a funnel. Most of the founders that, I encounter on average are having about 100 to 200 qualified investor conversations at the top of the funnel. P.S. Qualified is a very important word here. This is not like any investor that you just like randomly found online. These are people who really align well with you. And maybe you know this via Metal, or maybe you know this through other sources, but like they are aligned with your stage, with your industry, with what your company is doing. But generally speaking, most people need about 100 to 200 qualified investors at the top of their funnel to get to one lead investor at the bottom. So, and it is a process to, build that relationship over time to get to a point where one investor is ready to lead that round. So I just wanted to like calibrate, because in my conversations, a lot of first-time founders don't necessarily know the kind of scale that they should be keeping in the back of their mind. And then on the other question around like persistence, and I want to turn this over, Haley, probably to you on like, what is that line? But just a data point just for folks to think about, just in general, in the world of go-to-market, like there is a common adage around the rule of 7. Like generally it takes about 7 touch points before somebody like transacts or feels a sense of affinity for a person or a company. So thought experiment, if you are trying to get to that rule of 7 like positive touch points with an investor, in order to get to that yes, to that check, how do you think about running a tight process where you are following up with them in a very intentional way, but also not being like overly persistent or adversarial if they're not getting back to you?
Yeah.
Haley, what have you seen people do in terms of like threading that needle on following up?
Yeah. So just double clicking for a second, Kristen, on the process and that funnel that you're trying to move investors through. So while we are fairly generalist as a fund, we specialize in fundraising because we're so often the first check-in. So we spend a lot of time across the 600 plus portfolio companies we have helping them with fundraising. And what often happens is a founder says, okay, I want to raise a seed round in a month. So here's my deck and blurb. Here are 100 investors I want intros to. Press play, let's go, like seed round's going to be done. But what actually often happens is we need to go back and forth with them 5 to 20 times. I know it's painful, on revising the blurb, revising the deck to make it much easier to read. Remember, you're just trying to get investors to a yes on a meeting, like a first meeting, right? Just moving them down that funnel. So it's, what are the 3 sentences that are going to jump off of the screen or whatever voice agent people are using that's going to get people excited about a first meeting? What are the 10 slides that cover team, product, market, execution, and a bit about your fundraise that will let people know, okay, this is interesting, it's differentiated, the team makes sense, all these things. So spend a lot of time going back and forth. And then we say, to Kristen's point, okay, you sent us a list of 100 funds, but based on the Venn diagram of ideal fit funds across sector, stage, demographic, geography, etc., like 10 of those funds are a good fit. So we can make intros to those, and here are some more. But that process alone takes 2 to 4 weeks just to get to the starting line, to be able to send introductory emails, so forwardable blurbs that can be sent to our investor network, to then schedule a call, a week, 2 weeks in advance, because everyone's busy. You're super busy, investors are busy. So that process is really like everything you do before getting to the starting line on your new full-time job, which is fundraising. Once you're in the funnel with an investor, in terms of that follow-up, often people wait because I don't know how Renny feels about this, and probably less so because you're very thesis driven, you're specialists. But what we often see is some sheep-like behavior from VCs where people wait until someone gets really excited, a big name comes in, and that kind of helps herd the flock and get everyone into the deal. So investors may not want to pass; they want to kind of wait around and see what's happening, which requires a lot of patience from founders, which is annoying. What often works well is these really light touches. So one of the founders in our portfolio, actually, that I invested in maybe 9 months ago, does this super well. Every week, it's just oh, hey, like, had a great customer discovery conversation, like, here's a recording, or here's our new product demo, or we just signed an LOI. And it's just like, showing the execution week after week, not in these huge updates, not in are you ready to invest? Because you have to create some level of urgency. And if it's just like, have you made a decision yet? There's no sort of incentive, but to say, we closed 2 more checks and like, here's what's happening on the customer side. If you can show momentum from customer pull, fundraise pull, and or talent pull, like you were able to attract a cornered resource from like someone left Anthropic to come work for you. These are all really interesting things to investors. So I think those are a few ways I've seen founders thread the needle really effectively.
Yeah.
I love that.
So
Oh, sorry. Go ahead, Renny.
Haley's advice is so good. This is really great, and I wish she and Hustle Fund prepped every pre-seed firm for seed. Truly, I mean, that is actually how it all happens. So let me kind of take my take on that, and some of these, like I'll try and address a couple of these questions from the chat while I say this, which is your job as a founder is to get a lead check, and you should spend far less time with all the other checks that are only going to come in when a lead check comes in. To a couple of these questions, Haley addressed this. Well, how much do I follow up with someone if they're just not getting back to me with a hard no? The answer is they're, as Haley calls them, probably using sheep-like behavior and aren't going to move until a firm that they respect, that is a conviction-based firm, uh, leads, right? And I'd just say, like, seed firms like us, like, we're leading 20 companies per fund cycle, so that's like 5 a year. That's a lot of the good seed funds. Some seed funds have different practice and do more like 10 a year. In order to get to 40, it's all about portfolio construction, but it is that is what you're up against. And if you're feeling like someone's falling off, you're probably not wrong. They're probably not as interested in your company. And the other thing Haley said is so critical. And this is part of my life and Haley's life too, which is, think about, like, for anyone, like, if you're just saying, hey, did you have a chance to, like, see my email? Like, do you want to lead my round? Like, that's not going to work, right? And it's the same for us. If we're pitching a prospective LP that we believe has interest, but we haven't talked to in a while, there is a 0% chance that LP is going to come back with something positive if we say, hey, it's us, like, anything on your end. No, it's what is the positive news from our portfolio, and really you're kind of waiting for that catalyst to go back to that person. And the other part that Haley said that I really liked is, it is a numbers game for sure, but and this is why, like, metal is so critical. It's a numbers game, but if you're trying to have active dialogues with 100 different firms, that's too many. But if you're like, okay, I've identified, I've spent like 3 days going deep on, like, every podcast some GP has done at one firm, and you're only pitching that person, like, whoa, like, that's too much, right? So it's finding that balance, like Haley said, who and why are my top folks, and you can feel it as a GP, like, when someone comes to you with a very relevant and curated pitch, like, that's means a lot more than if it's like, you could just tell it's like some AI generated thing that went to me and 200 other VCs.
Like, Renny, Haley, these are like such great answers. What I'm hearing a lot of is like, kind of a call for founders to understand the game a bit more, right? Like it seems to me like the founders that you're most impressed with are the ones who kind of understand this environment and this ecosystem and what it actually takes to get money from a VC. And they've spent time to learn that. They understand the process. They understand kind of what to say on these calls, what the signals that actually matter here. And like kind of like sticking to that theme, I guess. Like now that we've talked a lot about like process and like gaining meetings, let's talk about the in the meeting stuff a little bit here. Um, so if we're talking about metrics, like now we theoretically have an audience of a bunch of founders who have fundraised as a pre-seed company and maybe didn't even have to have any metrics, right? Like at that stage, but now they've grown up and they're raising their seed round. Okay, so I guess like from your perspectives, like what like are there any metrics that founders lead with consistently that you find the most meaningless? Um, and like what's one they almost never mention that you actually care about too? I'll let anyone take this one.
Yeah, happy to jump in. Renny, thank you for the kind words and totally agree with everything you said. In terms of meaningless metrics, there are a few things. So one, we all know that even at seed, the forecast is a little bit of a fib. Not in a bad way. You're not trying to make stuff up, but it probably is you know, nothing's final. Nothing's definite. It's good to understand, more important than like the hockey stick itself, what are the core drivers of hockey stick growth? Because often there are many layers to the sort of growth that we look for in venture scale companies. So we've talked a little bit about how Renny focuses on at first in on a smaller number of companies and is quite concentrated, very conviction driven. We invest in a lot of companies at Hustle Fund. We have to believe in these huge outcomes for every company that we invest in. So 100x plus from that entry valuation at pre-seed, which means that we do want to see really big revenue numbers, but not just for the sake of big numbers. It's really about like what are the drivers, which then helps us understand what are our must believes for this company to do well. So if you say that, okay, like we're going to grow through this like seat-based SaaS model and everyone's going to pay, $10,000 per seat per month, I'm probably going to be a little bit concerned about that driver in the current environment, right? That may fall apart a little bit. So I think it's not just showing the numbers, it's explaining the why. The other thing that can be a bit meaningless is like pipeline. And Renny, I'm curious if you see pipeline a lot, but often it's like we have 100 million in pipeline, but it's very unclear what that means. So what's helpful is understanding, is there a trigger point for conversion? Is it as soon as we raise the money to be able to afford a SOC 2, like this will be wired to our bank account, versus we've had conversations with customers that we're loosely valuing at 100 million in revenue, but no one signed anything. So just try to be specific there. In terms of metrics, I wish founders spoke about more. This kind of goes back to this idea of drivers. What is core to your business model and your market that may make an investor either say yes or no? And I know that's so vague, but an example is often the reason investors don't want to invest in competitive spaces is not because your idea is bad, because it's going to be really expensive to acquire customers. So to invest in a competitive space as a tiny check, we write a $150,000 check, I have to believe the unit economics, so the customer acquisition cost relative to the LTV, the lifetime value of the customer, can be good enough that like it doesn't matter that it's competitive because you have some crazy exclusive distribution channel where you can make the unit economics work. So I think it's sort of understanding, okay, what's the elephant in the room of the idea you're going after, the market that you're in, the companies that have died before you, and trying to address that in a metric driven way. Again, very vague, but couple of things on the like don't need to see it so much and would love to see more of as well.
Yep. That's great. And I think I mean we'll often just have the founder kind of skip through the total addressable market size and just not even it's like again, as a specialist firm, not generalists, I think we have a good understanding of the market sizes with our lens. And really it just gets back to that like embrace of how are you executing now and what is that longer term vision? And really it's like, I think we're also looking for is this right? And I mean, we literally wrote a blog about it called Embracing Dichotomies. Is this a person who's inspiring and has vision? And also, can they deliver month over month, quarter after quarter? And in that, like I absolutely at seed stage, right? At seed stage, and seed has changed over the last half decade. What we mean by seed stage has changed. There are more elements of traction that one needs at this stage now than perhaps a few years ago. So if I look at that, I think we're really interested in seeing the pipeline. Like we absolutely want to see your pipeline. And then what is in a second or third meeting, as we parse through that pipeline with you as the founder, it gives us a really deep understanding very quickly as to is that pipeline real? Is it not? Are you someone who is, an optimist, but also an honest optimist, or are you not? And if you're living in a world of being really hopeful that this big pipeline is going to convert, that's not great. But at the same time, and again, this is why it's like we get it. It's a delicate balance. If you're overly humble that you probably won't get any of it, that's not great either. So again, I mean, these are kind of the qualitative, delicate balance type of founder that we're looking for because we want someone who's going to really be relentless in their focus on year over year revenue growth, delivering value for customers, right? And many founders we talk to do not have that. We're fortunate that the companies we've backed, they end up growing really quickly and in stark contrast to many other founders because we really screen for that hard by going through your pipeline with you in meetings 2 and 3, line by line. Like that's we find that to be a great use of our time as part of our diligence process.
Can I ask Renny a question quickly? I'm curious on the TAM point that you made, Renny. You said you'll go through the slide, but you already have a really strong understanding of the markets you're playing in. Are a lot of the markets you're focused on more mature, where someone's coming in to disrupt a mature market, or are they sort of nascent markets where the TAM today may not be that exciting, but you sort of know based on where the puck is going that they're going to expand dramatically over the next sort of decade?
Yeah, great question. And we are open to both. I think what I'm really talking about is when we see. I mean, we view everything with a security lens, and we might be looking at an AI or data company, we might be looking at a cyber company, we might be looking at a defending the skies from unmanned systems company. It is the sort of lazy. The total addressable market in cybersecurity is X number of tens of billions of dollars globally. Like that, we just like
Yep, makes
wade
sense.
through. Yeah.
Thank you.
That's a great question, Haley, though, because I'm hearing more investors than ever asking why now. Like, and I think that's because I mean, a lot is thanks to AI, thanks to the administration and spending priorities, like a lot is changing very rapidly. And so I do think that like that question of why now is coming up more frequently in investor conversations than it ever has before. And I do think you're right that like a lot of investors are oftentimes like investing based on like where the puck is going because they see how these sands are shifting. Really mixing metaphors here, but you know what I mean there. Along those lines, so one of the topics that we wanted to dig into a little bit further was around like momentum. And Renny, you alluded to this as well when you were talking about the pipeline. And then Haley, you touched on like market pull. In my experience, like that's a huge thing that investors want to see the data on. They want founders to be adept at telling the story about. How do you get a feel for the momentum that a founder is creating and building, or the market pull that they're getting? And like, how does a smart founder communicate that to you well?
Sure. So I'll start. I think it's a blend of the numbers and the narrative. So if you have market momentum, you know it, and it's your ability to articulate that strategically without overdoing it that is the most compelling. So if
Do
it's
they do
real.
that just with numbers, in your opinion, Renny? Like, is it like, does it all kind of come down to like the numbers and then the growth rate that they're showing, or are there like other elements?
Right. I think it's the numbers and it's the narrative, but behind that. So it's the
Mm.
founder's ability to take the nicely early growing numbers and without overstating it, it's like, okay, great, you had 4,000% growth month over month, but last month was $1 and now you're, at $4,000. Like that's like let's just be honest about what we're talking about here. But it's your ability to contextualize, again, the narrative, the strategic lens, contextualize the great early growth that you've had and show us, not in a kind of lazy TAM slide, but in a, we this early progress has shown us that, the 10 or 20 other buyers that look like the person who bought in this instance are now, like we can see how our sales cycle is going to shorten now that we've got this great first account. It's just putting that in context, without just over extrapolating. Oh, we got this one piece of early momentum and now it's game over, right? It's like, how are you going to build that into something much greater? And then let me just quickly say too, and this I think gets at some of the questions about, do you need real revenue at seed? Seed is now different than it was 5 years ago, right? Like the average seed round is many more millions of dollars at a much higher valuation than what we used to call seed is frankly now what pre-seed is doing. So you do need some traction, but that traction can come in many forms. And if you're building a capital expenditure, CapEx intensive business, those are businesses in which we invest, and those measurements are different. You're expecting less revenue in the early days because you're really having to invest in the build of the technology solution in the early days. But that just puts the onus on the founder to show and tell numbers and narrative why that is going to be worth it over time.
Love it. Anything you would add, Haley?
I mean, I think Renny summed it up beautifully. Like, it's numbers and narrative. Elizabeth Yin, one of the founders of Hustle Fund, former founder, sold her company, and then ran the 500 Global Accelerator, talks a lot about market pull, and will often say she'd rather back a team that's okay in a market that's moving really quickly versus an amazing team in a kind of, not so great market. And I think we're seeing that a lot right now. To Kristen's point, why now does matter a lot. And yeah, in terms of communicating it, numbers, narrative, sometimes, I mean, at the stage we're investing, it's often customer screenshots. And to Renny's point on whether or not you need, sorry, screenshots from emails and texts and that kind of thing, whether or not you need revenue at seed, being able to highlight customer interviews that you've done or connecting seed investors to customers can help a lot. And we see this often in diligence for companies that we're supporting. But yeah, I completely agree with what Renny's said.
Thank you.
I love it. Okay. So I'm curious. I have a cap table question. I feel like I'm gonna step on Kristen's viewpoint here, but I'm curious. Is there any world where like a messy cap table, or like are there any red flags around cap tables that like founders who are raising a seed round should be considering?
on my toes, PS, because like given that we are in the cap table management and cleanliness business, this is actually music to my ears, given the fact that like we help people do that. So sorry. Back to you, Adam or Haley.
Yeah, I
Yeah.
asked for a reason.
It's a nice layup. Thank you.
So we often say at Hustle Fund that your first investor meeting is like a first date. Speak only of pleasantries. So the cap table and all the skeletons in the closet don't tend to come out. But of course, you need to disclose weird stuff proactively, because finding out about how messed up a cap table is after doing onboarding paperwork and a verbal commitment is not good for anyone. So some of the things where we've seen deals fall apart just from a cap table standpoint, one is founder ownership. So again, we're investing super early. You would expect founders to have 80 to 100% of their company. We've seen as little as 17% for one of the co-founders at that stage, and that often happens because startup building is a long and winding road. Maybe you went through multiple accelerators, pivots, dilution came, kind of hit you hard over time. But our concern as investors is, are you going to be incentivized to stay in the game long term? To Renny's earlier point about a 5, 7, 10+ year relationship. We're not investing for quick exits, and we actually hate seeing an exit slide at pre-seed. We want to know you're going to go all the way and build a generational company. So that dilution is a big one. Things like whether or not there's an equity or a vesting cliff for various co-founders. We've seen this get very messy over time, where maybe everyone's friends and we're starting this together, and it's us against the world. And then after a year, things get messy, a founder walks away, and all of a sudden they take 5%, 10%, 15% of the company with them because all of their equity vested immediately. And we have really seen this happen, and we have seen seed stage deals in particular blow up because of that. So those sorts of protections are important. The last thing I'll say, post ZERP 2020, 2021, we saw a lot of companies maybe raise at higher valuations. Then over the last few years, they've had to raise at slightly lower valuations. There have been down rounds. Maybe those down rounds have complicated dilution and equity ownership. So some investor has come in and said, let's do what's called a recap. So let's kind of reset how this business and cap table looks, which can be positive, but it creates a lot of mess. And again, it's not a nice surprise if it hasn't been disclosed proactively. So those are three key things that we see kind of derail deals.
Amazing. I had one quick question before Renny gets in and like gives his point of view. How much of it, I'm still stuck on that 17% founder, frankly. That's like awful. There's obviously more examples of like the medium bad case there. How much of this is on the founder versus the investors that come into their round to like manage that side of things?
Yeah, so that's a great question, Adam. The 17% ownership actually has a very happy ending, which is great. And it's publicly visible on the pitch, a company called Bevs. So I don't, feel bad sharing this because I think it's a really informative sort of story. The investors were so concerned, like so excited about the vertical SaaS that was being built, but so concerned about the founder ownership, they went back and renegotiated. And it actually made sense. One of the co-founders was able to essentially pay the other co-founder a salary, and that's why they had less ownership in the business. But still, we wanted to make sure it was right before making an investment. So, yes, it can be fixed, but just word of warning there.
That makes sense.
That's right. And I think one sees a lot of founders, co-founders leaving businesses, and what that yields out in 2 to 3 years is really hard feelings on behalf of the people that have remained in the business. You're going to need to incentivize new executives. And if there's nothing worse than a fully vested founder leaving the business and the co-founders who are remaining being like feeling like, and because it's true, they're, doing the hard work now, and just benefiting that person who's, no longer has their head in the game. Just to address a couple of these questions that relate to this on from the questions here. How do you value grit versus initial success? If someone shows hustle, but one delivered outcomes and one hasn't, I think frankly, if someone has already delivered outcomes, perhaps obviously that would, having demonstrated an outcome is a more compelling metric. That said, if we share a founder's conviction, and this is in the, how do you value grit versus actual outcomes so far, that doesn't mean we would not invest. That just may mean that the valuation for someone who's accomplished a bunch versus it has not delivered the output, but we have believe that they could, that just may be a different kind of size and shape of round. To the quick question on how constrained our funds with ticket sizes. We keep being too big or too small. Is it possible to just skip seed and go to something else? Yeah, I mean, it's possible, but I think often, and here's where, we'll just being very honest with this group. Um, and I believe that neither First In nor Hustle Fund has this attitude, but a number of venture funds that are telling you, oh, you're too big or too small, that just means they're not interested in your company and they don't want to be direct with you. And again, it's not always as fun being someone who's direct and being honest with founders that we're not going to invest. But we deal with this a lot with our founders as we prepare them for Series A. And they're like, oh, we talked to this great firm, but they just don't have the, blah, blah. And it's like, no, that just means they're doing a soft pass. And it's really hard for the founders to hear because VCs abdicate their responsibility in this ecosystem. And I think as former founders, Haley and me, that is something that really bothered me when I was on the founder side, and it all comes out because you get to know these people over the months and years ahead. So, in my view, if a venture firm's telling you, "Oh, you're just too small," or "Oh, you're too big," that just means they don't want to invest. If you are someone a venture firm really wants to invest in, a firm can do it. There are some exceptions. Oh, a venture firm's at the end of its fund life and hasn't raised their new fund yet. They're edge cases, but in general, if you're being told you're too big or too small, that is probably because the firm wants to kind of keep you on a slow roll and is not really interested.
Okay, wait.
Real
Hold
talk.
on. This is such a topic, right? And so I'm just gonna ask point blank, why do VCs do this to founders?
It's
Mhm.
easier. I think, I mean, I don't know. I've sat, I mean, maybe less so now with all of the tooling available, but I've sat in front of my computer for like an hour plus just trying to figure out what to say to a founder that I really liked. I loved their company, but ultimately, like in the force ranking game that is investing, right? Because we're figuring out where's the best place to place our LP capital to get them the promised return to be able to raise another fund and back more founders. They're number two on the list of the companies I've talked to in the last month or 2 months. Like that's not a satisfactory answer, right? Like silver medal, but no check. So I think part of it is just it's easier personally, but maybe Rennie has another thought.
Yeah, I think perhaps that's it, or perhaps it kind of keeps optionality. And this is if you think about like human incentives. Like I have found that it's just the personality of my fellow GP at First In and I that we're both, veterans of startups, multiple, and we believe that in the medium and the long term, one, it's just what we believe and how we do business. Two, in the medium and the long term, if we have been clear with a founder and said, we are not investing now, but we really like you, and please, we'd love to be helpful, a year from now, whatever, that's actually honest. If we just say, it was great to talk to you, we're not pursuing an investment, that means like hard no. But if we say we actually would like to continue to get to know who knows? Maybe that founder in a year will be someone we will invest in, and that happens a decent amount. So if venture firms are not doing that for you, I think it's because they want to retain some optionality, and that's just something, having lived it as a founder, that I really didn't like. And by the way, some of the firms that did that to me as a founder are now firms that would want to invest alongside us, right? Like this, again, it's a long game here in startups and venture capital. Many of you on the call, if most of you are founders, it could be that in 5 or 10 years you're sitting in the seats that Haley and me are sitting in, and my hope is that you will not treat founders the way that some firms choose to do business. But yeah.
I genuinely wonder if this is actually the real answer to the difference for operator turned investors. Uh, right? Like this feels to me like you guys are coming from a place of deep empathy around this, and you're actually able to see how this impacts founders. And so that's why you give straightforward answers. Man, I'll just shout it out to all the VCs out there who might be listening. It's like this is one thing that actually is really harmful for founders, and they don't maybe realize how much it hurts them. Not just like emotionally, but like actually strategically and helping them be successful long term. Because if they think that they have a chance, but they don't, like it's not helping them iterate and change in the right ways to pitch new investors and get better at what they're actually doing.
What? So I love that Renny is like mad about this because I think it's such an important topic. Not to like, project an emotion on you, but you're so right on. And like we love getting to work with the funds that are, the good guys out there that are doing business well and supporting founders and being thoughtful. Transparently, sometimes I'll send a pass to a founder that I don't think it's the right fit for us, and I won't go deeper. I won't share feedback because I think sometimes VC feedback actually is misleading to founders, where it's like, look, this is not, there isn't that clear why now for this market. The founder market fit maybe doesn't make a ton of sense. But we're not going to go deeper on feedback because it's not super actionable. I do think it'd be helpful to come back to market pull for 1 second if we can. And it ties into a question someone asked around AI in the chat and how quickly it's changing the game, especially in tech, and how it was easy to raise maybe previously on a product that was built, but now as the barriers to entry drop and anyone can build, an MVP, what do you actually raise on? And coming back to Kristen's point on why now, market timing is so important. But what I think we'll also see is a lot of companies converging around the same ideas, which creates a lot of competition. So just coming back to market pull for a second, it is important to think about what are the technological, regulatory, and or cultural tailwinds that you're riding that are going to make it easy for customers to adopt and for investors to want to back you. But once you start to go that direction, you start kind of tiptoeing into the obvious arena, which it's really hard to build in and win in. And even if you can raise the first round, the second round is often a lot harder. So just a word of caution, like we're still looking for unique ideas within that why now theme.
I love that. I think we have time for one more quick one. Kristen, do you have one that's on your mind that you want to ask? Or should we wrap it up?
Let's see. So I guess like one thing I've noticed that I feel like a lot of industries are converging right now. I think so. I guess I'm curious. Like, what are some of the overlaps on the Venn diagram that you guys are both excited about in terms of how like people from two industries who historically didn't like overlap too much are like kind of coming closer together? Haley, I saw you nodding. Did you have one in mind?
Um, I think like fintech and health is sort of interesting. I would be curious to get Renny's thoughts on security in every product. I don't know how much that's a thing. I would not write a blog post about that. Don't worry, Renny. But it seems like there's just so much more need as the attack surface expands. So it's a great question. Still thinking about this one.
Right. And certainly the security lens that we have means that we are looking for any tech advance to have a security first mindset, and that as we can see with some of the advances in AI is not always true. This is a front of mind issue for CEOs, for chief information security officers in the commercial space. It's also a front of mind issue more and more for government organizations. As if for anyone who's been following what's been happening with Anthropic and OpenAI and the U.S. government. So this is it is so timely, and I think those who really understand customer needs, which are changing quickly given advances in technology these days, are really have a huge head start over people who are building kind of initial prototypes, hoping that those might be interesting at some point to a market. But I know we're at the top of the hour. I just want to say thank you to the Metal team, Adam and Samir, and Kristen at Fidelity Private Shares, which does a great job for our startups, and to Haley, great to see you virtually, and thank you.
Thank you all so much. Learned a ton. Renny, thank you for sharing your expertise. Adam and Kristen, thanks for having us.
So much fun. Thank y'all.
Thank you everyone for attending. We'll follow up via email again to our panelists, Kristen, everyone. Thank you so much. We'll see you at the next one.
Take care.